Watch video 50 on Chapter 10, Risk, Return, and Performance of Funds from the Workbook for NISM Series 5A, Mutual Fund Distributors Certification Examination, and review the multiple choice questions and answers. 1. What is a segregated portfolio? A. A portfolio that is fully liquid. B. A portfolio comprising debt or money market instruments affected by a credit event. C. A portfolio exclusively for equity investments. D. A portfolio with high credit ratings. Answer: B. A portfolio comprising debt or money market instruments affected by a credit event. 2. When was the creation of segregated portfolios permitted by SEBI? A. January 2018. B. December 2018. C. November 2019. D. September 2019. Answer: B. December 2018. 3. What is considered a credit event for creating a segregated portfolio? A. A downgrade in credit rating by a SEBI registered credit rating agency. B. A change in interest rates. C. A market crash. D. High inflation. Answer: A. A downgrade in credit rating by a SEBI registered credit rating agency. 4. Under which circumstances can a segregated portfolio be created for unrated debt? A. At the discretion of the AMC. B. Only in case of actual default of interest or principal. C. Whenever the market fluctuates. D. If the issuer has outstanding rated instruments. Answer: B. Only in case of actual default of interest or principal. 5. What must an asset management company, AMC, do upon receiving information about an actual default? A. Wait for further instructions. B. Inform AMFI immediately. C. Create a new fund. D. Sell the affected securities. Answer: B. Inform AMFI immediately. 6. When was the SEBI circular that allowed the creation of segregated portfolios for unrated instruments issued? A. December 28, 2018. B. November 7, 2019. C. January 1, 2020. D. March 15, 2020. Answer: B. November 7, 2019. 7. What must new schemes launched after November 7, 2019, include regarding segregated portfolios? A. No specific provisions. B. Enabling provisions in the Scheme Information Document, SID. C. Investment strategies only. D. High-risk investments. Answer: B. Enabling provisions in the Scheme Information Document, SID. 8. What is the role of trustees in the creation of a segregated portfolio? A. Approve or deny the proposal for a segregated portfolio. B. Manage the investments directly. C. Collect fees from investors. D. Approve all AMC policies. Answer: A. Approve or deny the proposal for a segregated portfolio. 9. What must happen immediately after the trustees approve a segregated portfolio? A. Investors are allowed to redeem their investments. B. A press release is issued regarding the segregated portfolio. C. All assets are sold. D. New investments are solicited. Answer: B. A press release is issued regarding the segregated portfolio. 10. What happens to the net asset value, NAV, of the segregated portfolio after a credit event? A. It is frozen indefinitely. B. It must be disclosed daily. C. It is ignored. D. It is calculated only annually. Answer: B. It must be disclosed daily. 11. Can investors redeem units from the segregated portfolio? A. Yes, anytime. B. No, no redemption is allowed. C. Yes, after 1 year. D. Only with trustee approval. Answer: B. No, no redemption is allowed. 12. What must AMCs do to facilitate exit for unit holders in the segregated portfolio? A. Liquidate all assets. B. Enable listing of units on a recognized stock exchange. C. Charge a fee for exit. D. Wait for 1 year before facilitating exit. Answer: B. Enable listing of units on a recognized stock exchange. 13. What is the total expense ratio, TER, on a segregated portfolio? A. It is fixed and high. B. No investment and advisory fees can be charged. C. It can exceed the main portfolio's expenses. D. It is calculated monthly. Answer: B. No investment and advisory fees can be charged. 14. How is the legal charge related to the recovery of investments handled in the segregated portfolio? A. It is not charged at all. B. Charged to the main portfolio. C. Charged to the segregated portfolio in proportion to recovery. D. Charged separately without limits. Answer: C. Charged to the segregated portfolio in proportion to recovery. 15. What happens if trustees do not approve the segregated portfolio proposal? A. All investments are liquidated. B. Applications are processed based on the NAV of the total portfolio. C. New subscriptions are denied. D. All investors lose their investments. Answer: B. Applications are processed based on the NAV of the total portfolio. 16. What are the risks associated with holding units of a segregated portfolio? A. Guaranteed returns. B. Inability to liquidate holdings until recovery. C. Unlimited liquidity. D. No risk at all. Answer: B. Inability to liquidate holdings until recovery. 17. What is a major concern about the liquidity of units in a segregated portfolio? A. High trading volume. B. Active trading in the stock market. C. Lack of active trading may lead to lower trading prices. D. Guaranteed liquidity. Answer: C. Lack of active trading may lead to lower trading prices. 18. How are units in the segregated portfolio allotted to existing investors? A. Based on their last investment. B. Equal number of units as held in the main portfolio. C. On a first-come, first-served basis. D. Based on investment size. Answer: B. Equal number of units as held in the main portfolio. 19. What does NAV stand for? A. Net asset value. B. New asset value. C. Nominal asset value. D. Net annual value. Answer: A. Net asset value. 20. What is the consequence of a security being marked down? A. Increase in investment. B. Decrease in the price per unit. C. Immediate liquidation. D. Guaranteed recovery. Answer: B. Decrease in the price per unit. 21. How often must the NAV of the segregated portfolio be declared? A. Weekly. B. Daily. C. Monthly. D. Annually. Answer: B. Daily. 22. What kind of securities can comprise a segregated portfolio? A. Only high-rated securities. B. Debt and money market instruments affected by a credit event. C. Equity securities. D. Only government bonds. Answer: B. Debt and money market instruments affected by a credit event. 23. What is required of AMCs regarding policies on segregated portfolios? A. No requirement. B. A verbal agreement with trustees. C. A detailed written policy approved by the trustees. D. An informal policy among fund managers. Answer: C. A detailed written policy approved by the trustees. 24. What should be included in all scheme-related documents regarding the segregated portfolio? A. Complete investment strategies. B. Adequate disclosure of the segregated portfolio. C. Detailed descriptions of all securities. D. Predictions of future performance. Answer, B. Adequate disclosure of the segregated portfolio. 25. What happens to the NAV of both the segregated and main portfolio after a credit event? A. They are both frozen. B. They must be disclosed from the day of the credit event. C. Only the main portfolio's NAV is disclosed. D. NAVs are calculated annually. Answer, B. They must be disclosed from the day of the credit event. 26. What type of investment strategy is associated with a longer holding period? A. Higher volatility. B. Lower volatility in returns. C. Guaranteed returns. D. Increased risk. Answer, B. Lower volatility in returns. 27. What is a primary reason to match the holding period with the portfolio maturity of the fund in debt investments? A. To avoid fees. B. To mitigate interest rate risk. C. To maximize short-term gains. D. To improve liquidity. Answer, B. To mitigate interest rate risk. 28. Which of the following risks is associated with a segregated portfolio? A. Guaranteed liquidity. B. Market fluctuations leading to lower returns. C. High trading volume. D. Immediate recovery of investments. Answer, B. Market fluctuations leading to lower returns. 29. What is the maximum amount of legal charges that can be charged to the segregated portfolio? A. Unlimited. B. The same as the main portfolio's TER limit. C. 50% of the NAVD, no limit. Answer, B. The same as the main portfolio's TER limit. 30. What can investors expect if they hold a segregated portfolio for a long time? A. High likelihood of negative returns. B. High probability of earning decent positive returns. C. Immediate liquidity. D. Guaranteed high returns. Answer, B. High probability of earning decent positive returns.